The gold, yeah, it's really not there because technically Treasury holds it. I also think it might just be a scaling issue because it's held at $42 an ounce and statutorily, and so $42 an ounce on whatever 260 million ounces is, if my zeros are right, $11 billion, and $11 billion on a $9 trillion balance sheet is, it's really hard to see. Oliver's takeaway was look, just to get back to the long-term average where gold made up, I think, a third to a half of the Fed's balance sheet. I think it was what, $8,300 to $13,000 an ounce would do the trick. And that assumes, no other crises, no other balance sheet expansion, any of those things. So, gold would have to double to triple just to get back to the long-term average, from here.
The Federal Reserve's balance sheet hides a massive distortion. Its gold reserves are statutorily valued at a mere $42.22 per ounce, rendering the total book value a negligible $11 billion against $9 trillion in liabilities. This accounting relic effectively masks the proper leverage of the system, treating the Treasury's most significant hard asset as a rounding error rather than a strategic reserve. Luke Gromen, founder of FFTT, Forest for the Trees, argues that correcting this imbalance to match historical norms requires a massive repricing event. He calculates that if gold were to return to its long-term average, where it represented between 1/3 and 1/2 of the central bank's assets, the price would need to surge to between $8,300 and $13,000 per ounce. Gromen notes that this target is merely a baseline to restore the long-term average, assuming no new crises or further money printing, suggesting the current market is drastically underpricing the monetary energy needed to stabilize the ledger. Now, we present the clips from Luke Gromen's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
You got to get rid of the Treasuries as primary reserve asset. You got to discredit them as primary reserve asset. You got to get gold moving back to the people where ahead of time, to the big creditor nations. Then you got to ramp up the gold price. And then eventually we can revalue the gold and pay down our debt or recollateralize our debt and rebuild our defense industrial base. And there's days where I feel like, yeah, I can see that. And then there's other days where they're just mucking it up as they go along. The composition of the Fed's balance sheet from its creation to today. And when it was created, it was all gold. Then it was all gold and commercial bills up until World War II. And it's steadily, particularly after, call it 1965, a lot less gold. And, now it's entirely long duration bonds of a bankrupt Congress, as he calls it, in which I agree, and mortgage-backed securities, which are also very inflation sensitive. And the gold, yeah, it's really not there because technically Treasury holds it. I also think it might just be a scaling issue because it's held at $42 an ounce and statutorily, and so $42 an ounce on whatever 260 million ounces is, if my zeros are right, $11 billion, and $11 billion on a $9 trillion balance sheet is, it's really hard to see. So, yeah, I think this goes to show the Fed's balance sheet has gone from gold plated to basically crap over the last 100 years. And look, it's nominally money good. It's absolutely nominally money good. The U.S. government is not going to default on those, and the U.S. government backs those mortgage backs. But it's a Ponzi scheme, right? Like the government borrows money, the Fed buys it, and then guarantees the bonds the Fed buys. Like, great. Like, people are criticizing some of the AI financing schemes. Like, those things are pikers compared to this. This is like the granddaddy of them all. Lending money to somebody who's guaranteeing the debt that you're holding that you lent them. Like, hey, awesome. So that's the message of that chart. Oliver's takeaway was look, just to get back to the long-term average where gold made up, I think, a third to a half of the Fed's balance sheet. I think it was what, $8,300 to $13,000 an ounce would do the trick. And that assumes, no other crises, no other balance sheet expansion, any of those things. So, gold would have to double to triple just to get back to the long-term average. From here, why is the U.S. exporting so much gold? I think we are starting to move toward, basically we're sending it let me back up. The data show that we sent most of it to Switzerland. The Swiss are very precise with their records, which shows that most of that went to two places: China
and the UK, right?
If I wanted to, another thing I would do with red teaming China is I would call up the Achilles heel of the dollar system, which is the London gold and silver markets. And I would say, give me more. I would empty it out till either the price skyrockets or until they declare force majeure. And now pricing is set in Asia. So it's interesting to me that one debtor country is sending U.S. is sending a whole bunch of a whole bunch of gold to another trade debtor country, the U.K., at a time when gold flows have been clearly leaving the U.K. and over the last couple of years, and broadly speaking, going east, with the exception of earlier this year when they came here. So that was interesting. But the China side, gold is trade settlement. At the end of the day, look, I think people need to open their minds to the possibility that one of these trade deals is that the Chinese said, okay, we will restart rare earths, not for dollars anymore. We'll take gold, we'll take silver, we'll take value for value, but you don't make anything else of value. We can't use your software. Your chips, you're restricting like crazy. We don't want any of that stuff. We've actually said we've reduced our chips. We're coming up with our own aircraft, so we do need some Boeing parts still for the time being, but in another 5 years or 3 years or 8 years, I don't know what it is, but China's going to make their own aircraft and throw Boeing out like they've done to everybody else, so that we can't weaponize that against them. So yeah, when we once you eliminate the impossible, whatever remains, however improbable, must be the truth, right? Sir Arthur Conan Doyle. Why are we sending gold to China in the middle of a trade war when we've been restricting this and that? Well, it flies in the face of sort of China's collapsing, because you go back thousands of years. The countries that are buying gold are not the ones collapsing. It's the countries selling gold that are the ones that are having the fiscal problems. So look, I think that's probably, if you gun to my head, why did we send a bunch of gold to China? That's probably why. It is in the same way that in 1940, we did this to our friends in 1940, to the Brits. They were the reserve currency. They'd been the reserve currency for 150, 200 years. Hey, we need equipment, America. Can you lend us something? We'll pay you. Sure, but we're not taking sterling. We'll take dollars or we'll take gold. We don't trust the sterling. We don't want the sterling. You may lose. And so it's kind of the same setup, right? It's not a shooting war, but we've made it clear that we are trying to choke China out in a lot of different ways. The Chinese would have to be stupid to take printed dollars, back to that, your point about that Fed balance sheet, for some of these rare earths that we want to shape into weapons and point at them. So, okay, you're going to have to pay value for value. So I suspect some version of that is what happened. I have no proof of that. It's purely speculative, just to be clear. But like I said, you eliminate the impossible, whatever you have left is probably the truth.
The transformation of the Federal Reserve's balance sheet from gold-plated assets to long-duration government bonds reveals a systemic vulnerability often described as a circular financing mechanism. While the central bank ostensibly holds a massive reserve of bullion, an archaic statutory valuation of $42.22 per ounce renders this wealth invisible, appearing as a negligible $11 billion line item against $9 trillion in paper liabilities. Restoring the balance sheet to its historical average, where gold represented a third to half of assets, would necessitate a dramatic repricing, pushing the metal to between $8,300 and $13,000 per ounce. This monetary weakness is fueling a geopolitical shift, evidenced by significant gold outflows from the U.S. to China via Switzerland. This migration suggests a forced return to value-for-value trade settlement, in which rival nations refuse to exchange strategic resources, such as rare earth minerals, for printed dollars. Much like the U.S. demanded hard assets from Britain in 1940, China appears to be rejecting fiat currency for tangible wealth, forcing the West to settle its trade deficits in physical metal rather than paper promises. Let's get back to the interview.
I don't know what I don't know about what's going to happen the next 2 years around sort of everything, right? Like the geopolitical side, the monetary side, the AI side, all these things. And so for me, I'm just like, you know what? I think we may go through just this huge disruptive period of time, this culmination of the fourth turning, and I don't want to have any debt. And that was just sort of the calculus of, because it gives me so much optionality. It lets me sleep better at night. It lets me enjoy the lake house better if there's not a note on it. As cheap as the note is, that was really, it probably was the wrong thing to do from a financial standpoint, but it was the right thing to do from a state of mind standpoint, just given the rising discomfort with what I'm seeing. And I would date that back, let me be specific. When they shot Charlie Kirk, I think a lot of things changed. And I think that was where I started thinking differently about some of these sort of fourth turning, the Overton window, about what could happen over the next 2-3 years. And my Overton window, which is, I think, usually wider than most people's anyway, blew apart entirely. Like, I think there is, and for me then, just like, all right, well, in that world, I took a couple of months. I was like, okay, I was watching it. And then, some of the, what do I do with if I'm selling Bitcoin? I don't want to sell Bitcoin. Tactically, I sold Bitcoin because for the reasons it's highlighted, but I don't ever want to put my money into something that is not Bitcoin-like. And so you look around and you go, okay, I put some of it in gold. Some of it I put into cash just to kind of give me that optionality. So, but I didn't want to put it all, I didn't want to put it all into gold. I didn't want to put it all into cash. I wanted, what's the other Bitcoin-like thing to me that was like really obvious? For me, it was, hey, a lakefront lot, right? Lakefront lots, Bitcoin has not done against lakefront lots what Bitcoin has done against the median home value. And so that was part of it too, was like, okay, the financial engineering side, the mortgage rate, I'm like, oh, I really wrestled with that. But that's it's really about my Overton window of what could happen over the next couple, 3, 4, or 5 years is way wider than I think sort of a lot of people's. And it's a Bitcoin-like asset, and you can't go broke not having any debt. I'm a very big freedom guy, right? At the end of the day, if I have no debt, I'm free. I still own some Bitcoin, and I still have exposure through private equity investment that's in this space. So I still have exposure there. It was such a big part of my liquid net worth relative to what was a falling conviction in the near term, sort of clarity around a lot of sort of, okay, it's not trading like a neutral reserve asset. It's trading like high beta tech. B, high beta tech looks like it could have a really bad couple of months or quarters. C, the technicals look like absolute death, and they've crossed over in a way that has 100% batting average, bats 1,000 and foreshadows a 60 to 70% drawdown for the entirety of Bitcoin's life. And I just said, okay, that position is too big given those realities. For me, I think, I said to someone like, Bitcoiners hardcore Bitcoiners have forgotten more about the technology than I'll ever know. Where I feel like I have an advantage against a lot of Bitcoiners is I've been advising institutional investors for 30 years. And what when those charts break down on a long-term basis, whether it's true strength index, whether it's moving average, convergence, divergence, on a monthly chart, the way they have broken down emphatically, what I can tell you is that, if you're counting on institutional investors to like sort of, run it from, 90 to, 150 like that, if that's your plan, like that's probably not going to happen without some major catalyst. That's not how institutional investors act. Those charts, they're going to sit there and just go, I'll wait. At the very least, that suggests there's a whole lot of wood to chop for Bitcoin, technically, against both the dollar and against gold. And so, I think, I think you'd easily go to 60. The real, for me, and again, this is an issue of position sizing. When it was as big as it was, this was really uncomfortable. For now, it's like, okay, if it happens, it happens. It's not the end of the world. What happens if we do get an all-out trade war? What happens if Liberation Day doesn't get turned around right away? What happens if, it's not like it's only Michael Saylor out there buying, money, borrowing money and buying Bitcoin. There's a whole lot of treasury companies now And what happens if the world isolates the U.S. for a time, which is starting to look like it's happening, by the way, on some levels? What happened to those? What happened to those? If we go into a recession, which there's some metrics it looks like we're heading into it. What happens to the cash flows of those businesses? Do they have to turn seller? Do the Treasury companies of this cycle? Are they the sort of the forced seller like we saw around FTX in 2022? Right. The reason, in my opinion, why Bitcoin went below its prior cycle high. Remember, in 2022, it's like, well, don't worry, Bitcoin has never gone below its prior cycle high ever. Then it did.
The convergence of geopolitical instability, monetary shifts, and the fourth turning demands a radical rethinking of portfolio construction, where the primary objective shifts from maximizing returns to maximizing resilience. In this volatile environment, the ultimate luxury is not leverage, but optionality, the ability to sleep at night unencumbered by debt. Eliminating liabilities, such as paying off mortgages entirely, provides a psychological buffer against a widening range of disruptive outcomes, treating clear title to tangible assets as a form of sovereign wealth comparable to holding bearer instruments. This defensive logic necessitates a critical reevaluation of speculative assets like Bitcoin. Despite its long-term potential, the cryptocurrency is currently trading as high beta tech rather than a neutral reserve asset. Technical indicators on long-term monthly charts have crossed into bearish territory, a signal that has historically preceded drawdowns of 60% to 70%. This breakdown warns that institutional capital, often passive, will not step in to save the price without a significant catalyst. Furthermore, if the economy enters a recession, corporate treasuries holding Bitcoin could be forced sellers, leading to a liquidity cascade similar to previous cycle lows. Consequently, the prudent strategy is to reallocate to cash, gold, and unencumbered real estate to avoid a forced liquidation. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.